All right. Good evening, everyone, and thank you for joining us. We are right on 6 o'clock on the dot. Um, Welcome to our Retirement Planning Webinar 101. My name is Natalie Nahas. I am the Senior Business Development Officer here at the Credit Union, and we're really excited that you guys are joining us this evening. But before we get started, we do have a few housekeeping rules and items to cover. So today's session will run about approximately an hour long, but we will have time for Q&A towards the end. But we want to encourage everyone to type in their questions into the question panel to the right-hand side of your screen. And then at the end of our session, we'll go over them. Also, this session will be in listen-only mode, so it will be recorded and there will be a recording after in case you want to retrieve or access, or if you'd like us to email it to you, we can do that as well. So now with the housekeeping rules out the way, I want to introduce our guest speaker, and his name is Patrick Infante. Patrick is a certified funds specialist and a financial advisor here at LAPFCU. He specializes in investments and retirement, and he's been with us for a little over 3 years at LAPFCU, but he's been in the industry for over 30. So you can find him at the Academy branch for appointments, or he does travel to other branches as well in case you have an appointment. And he's also bilingual in Spanish, so in case you want to, you need assistance with that. So now I'd like to turn it over to Pat.
Hi, good evening, everyone. Thanks, Natalie. Good evening, everybody. Thanks for taking the time out of your busy schedules to join us tonight. As Natalie mentioned, my name is Patrick Infante. I'm a financial advisor, a wealth planner, many different titles. I've been in the industry for over 30 years. I've worked at various places, Merrill Lynch, Wells Fargo, TD Ameritrade. I do a lot of in-person, face-to-face planning, as well as over the phone, video conference calls, Teams meetings with members that move out of state. And tonight's presentation, of course, retirement planning, some of the basics about, planning for retirement, starting early, etc. To give you an overview, the importance of planning, early in life and, following and monitoring your retirement. As Natalie mentioned, there will be a question and answer session at the end of the presentation. I am, of course, an employee of LPL Financial, the broker dealer, and I'm at the Academy branch every day. So I'm going to start the presentation here. We'll go through these slides and again, please save your questions for the end. And I'm going to go off screen here while I go through the presentation. Okay, first of all, we're going to go through tonight some of your retirement mantras, okay? My goal here tonight is to help you understand, of course, the importance of saving as early as you can in retirement and saving as much as you can. Some of the things we're going to be covering tonight are your savings mantras, the 5 steps that help you achieve retirement savings success, how much money you're going to need into retirement, and also we're going to touch on the drop options, and we'll get into detail on all these as we go through the presentation. Okay. First of all, some basics here. So disclosure, of course, as I mentioned, I'm an investment advisor, a wealth advisor with LPL Financial. LPL is actually the largest independent broker dealer in the nation, nationwide. I cover various products, mutual funds, stocks. Obviously, stocks, mutual funds are not guaranteed, as it says there on the screen.
Pat?
Yes. Yes.
Sorry to interrupt. We just need you to share the PowerPoint, please. Sorry, I
Oh, I'm
think you missed
sorry.
that.
I'm so sorry. Okay. There we go. Oh, with a PowerPoint. Hold on a second. What's going on here? Hold on. Thought it was sharing. Oh, gotcha. Okay, copy that. Hold on a sec. Sorry about that. Share screen. Yeah. Okay, hold on a second. Sorry. Ah, just hold on. Sorry about this. 1 minute. What is this? Oh gosh. Oh, here. Sorry about that. Okay, share. Oh no. Sorry about this. Okay, 1 sec. Where's this? Share. Okay, here we go. How's that? Can you see now? Can you see now, Natalie?
Not quite.
Sorry about that, folks. Give me a sec. There. Okay. Sorry about that, folks. Can you see now, Natalie?
Yes, there you go.
Okay, sorry about that, folks. You can see the screen now?
Yes.
All right, sorry. So as I was mentioning here, disclosures, of course, investments, mutual funds, stocks are not insured. They do go up and down. Of course, I do also help with insured products such as CDs, government bonds, a variety of other products that do give you protection and insurance, okay? So let me go here. Right. Okay. First of all, I want to start with a somewhat sobering stat here that, oops, I'm sorry. Oops. Okay, saving mantras here. I think I got ahead of myself. Okay, I jumped the gun. Okay, here we go. Sorry about that, folks. Saving mantras went through. Okay, now here we go. On average, Social Security only replaces 40% of our income, okay? The income we're making before retirement, on average, okay? For some folks that have higher income, this percentage could be lower. And for folks in the lower income bracket, this number could be higher. So this is just an average. I'm sure some of you folks were probably surprised by this, okay? Getting only 40% of our income replaced gives us another reason, of course, and shows the importance of planning ahead and, putting money away for your retirement. Okay? So as I mentioned before, when it comes to retirement planning, there's a number of savings vehicles that we can use and choose from, which we're going to go into. But the two main things that we want to also focus on, the importance of starting as early as you can, and of course, saving as much as you can as we go into and through retirement. Okay? Now, there's a lot to think about, a lot of, planning into retirement, your lifestyle decisions to consider, where you're going to live, whether or not you're going to continue to work, maybe part-time for a period into your retirement, maybe for, temporarily. So a lot to think about. But again, the good news is that it's not too complicated when you really get a good overview and you know exactly, how you're doing and you have a plan in place. But again, one of the first savings mantras is start saving as early as you can. Okay, now here on this slide, if you Googled retirement savings in America, or you listen to some of the financial reports, the survey showed that the majority of articles that only 18% of folks out there feel confident that they have enough money to be comfortable in retirement. Okay. As far as those that feel somewhat confident that they're doing enough into retirement, only 46%. And those that don't feel too confident at all about, that they're doing well into retirement is 36%. Again, and also those that think that they are preparing correctly, only 22% of folks think they're very confident that they're planning correctly into retirement. 44% feel somewhat confident, and only 34% feel that they're not confident at all. So it's a smaller number, but still, there's a good percentage of folks out there that are not too sure what they're doing for retirement, if they're on track. And I'm sure when you folks look at your own situation, yeah, you may be one of these categories. Again, another reason why we want to start planning and reviewing your investment and performance and making sure we're doing the right things into retirement. Okay, so now back to applying our savings mantras, all right? Now, if you want to maintain your lifestyle in retirement, of course, that's going to be something you have to consider. Again, another reason we want to start very early in life and put as much as you can into some type of retirement account. Okay, we're all going to have different lifestyles and, different plans as we retire. So different situations, everyone's going to have a different goal, different situation. And my job is to help you plan for that, and budget correctly so we can get on track. So you're going to have the lifestyle that you want to have as you go into retirement. Now, on here, I want to turn our attention to what I'd like to call the 5 steps to help you achieve retirement savings success. They're pretty basics, but one, of course, again, is choosing your retirement savings vehicle. 2, start as early as you can. 3, increase your savings rate whenever you can. 4, don't forget, of course, about healthcare expenses you're going to have as we get older. And 5, seeking professional advice as you're planning as well. Whether it's from me or anybody else, it's good to get, if nothing else, a third opinion. You might think you're doing well, but there might be something you're missing. So you want to definitely try to get, some professional advice as you plan for and into retirement. Okay, now the most common retirement savings vehicles are your employer-sponsored plan, like 401ks, deferred comp, 457s that we have here in the city. That's the most popular and typically the best place to put money away. Secondly is IRAs, which are individual retirement accounts. These individual retirement accounts would be for folks that don't have an employer plan, right? They might not have something through their employer that's offered, or they might not qualify. So again, the IRA. And on the IRA, individual and the 401ks, you have traditional, which is pre-tax, and you have the Roth option. The Roth options are funded with after-tax money, and we're going to get into more detail about these as well. But these are the main vehicles you want to use to plan for your retirement and put money away. Now, first of all, for the employer-sponsored plans, again, 401ks, 457s, deferred comp. If you're in education, it's 403bs. The money contributed to these plans is on a pre-tax basis, right? So what that means is it goes in before you get your paycheck, right? You get your contributions that go into the plan. That does 2 things. It helps you, not even see the money go in. You know it's going in, but when you get your paycheck, the contribution's been made. Plus, more importantly, it brings your taxable income down, right? So if someone's making, let's say, $60,000 and they put in 5,000, 10,000, you're going to report less income when you do your taxes, right? So you're paying less on taxes. The more you put in, the less taxable income you're going to have, right? So the more you're going to save on taxes. Any investment, of course, in the employer plans compounds tax deferred. So it's growing tax deferred, meaning you don't pay any taxes on the growth while the money's building, okay? Of course, you have to pay taxes when you start taking the money out into retirement. Also, employer plans give you they choose the match. Okay, so your employer may give you a match, a certain percentage. So no matter what you're putting in, you might get dollar for dollar matching from your employer. Some employers might match 3%, 5%, whatever amount. That's a big benefit because it's free money that your employer is contributing back into your retirement plan. So that's another big benefit of the employer plans. Within these plans, of course, you typically have mutual funds. Mutual funds, of course, would be a basket of stocks. Okay, if we look at the U.S. markets, the S&P 500, the benchmark, the 500 largest companies in the U.S. has an average return of about 11%. So another reason why in these retirement plans from the employers, 401ks and such, they allow you to invest in mutual funds and typically in the market because the market averages a really good return historically, about 11%. The past 5 years, by the way, the market's done about 15.5% per year. So really strong returns. And again, within the mutual funds, you also have exchange traded funds, which is another type of mutual fund. These trade throughout the day. And these mutual funds can have stocks, bonds, a combination of both. So they could be a balanced fund. Or you could just be in a straight bond fund, right? Something that's giving you a steady income, 5 or 6%. Some folks may not want equity risk. As I mentioned before, the withdrawals are taxed at your income rate at that time. So obviously when we're working, we're paying more federal tax. Average federal tax is about 22%. Then we have state tax, about 9% plus with the state. Again, as we retire and we're making less income, most folks will pay less taxes, right? But you get taxed on the distributions as you start taking money out of your retirement plans. With the city here, a lot of folks have a pension, so they'll be in a higher tax bracket for the long term, which is okay though. At one point, we got to take money out. By the way, the required minimum distribution age is now 73 and a half. It keeps going up. So by the time you get to 73 and a half years of age, you have to start start taking out the required minimum of your retirement accounts, it's typically about 4% of the value of the prior year. So whatever the value was December of the prior year of you turning 73, that'll be the amount, about 4%, okay? Also, you must be typically over 59 and a half to avoid a 10% penalty. So again, if you take money out of any retirement accounts prior to 59 and a half, apart from the federal and state tax, you also have to pay a 10% penalty. Within the 457 plans here for the officers in the city, there's no 10% penalty, so that's something to be aware of. Again, if you take money out of the 457 deferred comp, there's no 10% penalty. So for any folks that retire earlier than 59 and a half, you may want to keep some money in that plan. Should you need to access some money, you'd want to take it out of there. The reason I mentioned that, typically when you retire, you would roll your 401k or your 457 into an IRA, individual retirement plan. So these are some of the basics, again, of the benefits of the employer-sponsored plans. Next, also within the employer plans, we do have a Roth option. So basically, you can be contributing a bulk of your money into the pre-tax bucket, and also you can be contributing to a Roth option. The Roth portion, of course, is after-tax money. There's no write-off against that, so you cannot write that off against your income. But on the Roth, the withdrawals are tax-free when you take money out. Also on the contribution limits for this year have gone up to 23,500. So the 23,500 is the max contribution you can make into your employer-sponsored plan. It's a pretty sizable amount, of course. If you break that down over 12 months, right, you can try to put as much as you can into your plan. It's a big amount that can help you save and really grow a nice nest egg into retirement. And as most of you folks know, that amount you're contributing is adjustable, right? So you can say, I'm going to try to put in 5 or 10%. And if you're getting by with that and you have some excess money, maybe you want to increase it or maybe you want to decrease it, right? To make sure that you're getting by, you're living comfortable. But it's very adjustable. You can change it any given month to make sure that, you're putting a good amount in and that you have enough, obviously, to live comfortably as well. Also, if you're over 50 years old, you can do an extra 7,500 into this plan. So it's a good amount that you can put into there, putting in an extra 7,500 on top of the 23,500. So really a big way to catch up when you're over 50. If you're over 60 to 63 years old, you can put an additional catch-up of $11,250. So again, $11,250 for those age of 60 to 63 on top of the 23,500 for a total of 34,750. So really big amounts allowed, so you can really catch up as we're getting older. If you didn't start early enough, you want to try to catch up and put some of that money away into your retirement plan. Here we're going to talk about the individual retirement accounts, commonly known as IRAs. Typically, these IRAs, again, not only are they used if you don't have an employer plan to put money away in for retirement, but they're also used as rollover options when you retire from a previous employer. So typically, no matter where you work, when you retire from your employer, you should roll over to an IRA, individual retirement account, for several reasons. First of all, the IRA gives you many more options of where to invest, different mutual funds, different stocks. You can also do growth, and you can add protection, so you're still in the market, but you're not taking risks. You can minimize the risk 100% if you want, or certain buffers, 20%, 30%. These IRAs are typically held by a bank, right, like our credit union, or of course through a brokerage account, investment account. Within the credit unions or banks, typically the IRAs, you can do CDs, things of this nature. On the investment platform, you have a lot more options, similar to what you're doing in your employer plan. Mutual funds, of course, are an option. You can add some stocks. You could be a lot more diversified. It opens up so many more investments, and again, also protection. As it mentions here, a much larger universe of mutual funds. For example, if you're with the city of LA, you typically have Voya. Some folks have Fidelity. You might have T. Rowe Price. But again, going into IRAs and individual retirement account, it opens up so many more institutional money managers that do really well for growth. So typically that's what I would do, build a portfolio out for members with a variety of institutional managers, some on protection, some on balance, mutual funds, etc. as it says here, all these other types of investments that are available within the IRA accounts. Okay, on the individual retirement accounts again, the contributions are tax deductible. So whatever you put in there, you write it off against your income. You tell your CPA, okay, I put the max in this year, 7,500, 7,000, whatever it might be, 8,000 if you're over 50. Also, investments are growing compound tax deferred, right? So that means, again, you're not paying any taxes on the gains or the interest you're getting monthly until you start taking it out. Again, tax deferred. By the way, there are other investments outside of IRAs that you can do tax deferred as well, just to be aware of. If someone says, hey, I have money in my savings account, I'd like to get some tax deferred, interest or growth, you can do that outside the IRAs as well. Withdrawals are taxed again at your income rate whenever you start taking the money out. So within the IRAs, again, these are straight retirement accounts, money you're gonna put away into retirement. Ideally, if you're making less income when you retire, you're going to pay less taxes, right? Less federal tax, less state tax. That's why most folks will wait until they retire. You might be getting Social Security, you might get a pension, and then you would use your IRA, that bucket of money, to maybe supplement your income, right? To generate another 2, 3, 4,000 or more of interest out of your account. And typically for my members, when we're taking money out of the IRAs, we're taking it out of interest earned. We're not trying to take it out of principal. You don't want to, deplete your account over the years by taking principal out. So that's why it's important to grow your account to a good value, so that with that balance, you can get, again, 2,000, 3,000, 4,000 a month of interest alone. And then your money's still working. Again, as we mentioned before, you have to be 59 and a half to avoid a 10% penalty, okay? There are exceptions, of course, as I mentioned, with the 457, or also for your first-time home purchase. You can take money out of your retirement accounts, the IRA, again, for your first-time home purchase. The Roth options are also available. The Roth, again, are tax-free growth. You contribute to these Roth IRAs with after-tax money. It's not a write-off, okay, but you're going to be taking the money out with no taxes when you start taking distributions. The thought there with the Roth IRAs is that when you think, hey, taxes will probably be higher in the coming years. So some folks will say, I'd rather do the Roth, pay my taxes now, and put the money in and know that when I take it out of the Roth IRA, I won't have any tax. Contribution limits, again, 2025 are 7,000. The catch-up provision, if you're over 50 years old, is an extra 1,000. So it's 8,000 total, but typically 7,000. As you can see here, the contribution limit is a lot lower than the employer plans that we looked at previously. That's why I tell my members, again, the first place you want to start saving is your employer plan with a limit of 23,500, a really big amount that you can put in every year. If you can hit that, or any amount above 7,000 with the employer plan, you're definitely better off doing that. And again, on the employer plans previously discussed, if you're getting a match from your employer, another big benefit. But again, on the IRA, 7,000 contribution limits currently for the year, with an extra 1,000 if you're over 50. Okay, now here I want to go over something here for planning, which is pretty cool to look at. It's called the rule of 72. This gives us an easy way to calculate how long it's going to take us for our money to double. Okay, you just take the number 72, you divide it by the interest that you're getting, okay, and that gives you the approximate number of years it will take for your money to double. Okay, so for example, if your money is getting 4%, you take 72 divided by 4, your money would typically double in 18 years. Okay, if you're earning 6% and you take 72 divided by 6, your money will typically double in 12 years. At 8% annual return, again, 72 divided by 8, your money will typically double in 9 years. And 10% annually, your money could double in 7 years. Again, as I mentioned before, the U.S. stock market averages about 11% return. So again, if you're putting in early enough, you have a lot of periods over the years where your money could potentially double several times, right? 2, 3, maybe 4 times, getting a double. So that's really important. Again, it ties back to starting as early as you can and giving your money as much of opportunity as it can to double. Okay. Okay, now typically, reasons you may want to increase your savings contributions whenever you can. You want to try to really, when you put money into your retirement accounts, you don't want to just leave it on cruise control. Okay, I'm going in at this percentage, whatever it may be, 2%, 4%, 10%. It's not just leave it on auto, right? You want to try to make it a resolution every year, maybe to increase your contributions if you can, right? Every year, maybe increase it as you can. Maybe you want to cut down on non-essential expenses and say, hey, I'm going to spend less on non-essentials so I can put more into my retirement account and really focus, right, on putting money away. Maybe every year again as a resolution. Even 1% a year can make a big difference over the long term. Not only cutting down, but maybe if you get a pay raise, you're getting paid more, or you got a bonus. Those are great times to maybe pay yourself first, right? Pay into your retirement account some extra contributions, or just kick up the percentage. You want to be smart with your budget as well. Again, maybe, spending less on going out to dinner or non-essential, so you can really have some extra money and contribute as much as you can, as early as you can, also into your retirement accounts. Okay, these are the contribution limits we discussed earlier. They went up again. 7,500 is the current contribution. The $1,000 contribution catch-up is still there. So total actually 8,500 now. The 401ks, 23,500 for this year. And the contributions there as well stay the same for the catch-up provisions, unless you're over 50, of course, or over 60 to 63 years of age. Okay, also something we want to cover here, which is very important, is the healthcare, right? A recent report from Fidelity Investments estimated that a healthy couple, 65 years old, retiring in 2025, has gone up from this figure to currently about $325,000 to cover their healthcare costs. Again, $325,000 for a healthy couple retiring, okay, in 2025. So quite a bit of money that you might need into retirement. Could be a little bit more, could be less. Also on AARP, there's a great calculator you can use there, healthcare cost calculator that you can run. But again, this is a really important thing to look at and plan around for your healthcare expenses, right? And making sure that you have enough, not only for your lifestyle, but also for you and your spouse for any healthcare needs that might come up as we get older. Also, we want to get, as I mentioned before, you should get professional advice. Even if you think you're doing well, maybe just someone to oversee your investments, maybe run a projection, make sure you're on track. Or you might say, hey, I'm putting money away, I'm putting this percentage in. We can actually run projections and say, okay, if you're putting this much per month and you keep rolling this over the next 10, 20, 30 years, we can get a projection of how much you might have into retirement. I recently had a member come in and say, Patrick, how much would it take me to put in every month so I can have $2 million at retirement? So we ran the numbers, we put it into the S&P kind of growth investments, and we got that number. Okay, we're putting 500, 600 a month, 400 a month, and in 20 years, you'd be hitting that $2 million target. So again, there are ways to back test the portfolios by going in and just putting the numbers in and giving you an idea and giving you a real true life target. So sometimes that makes it more exciting. You say, I have a plan in place. I'm putting money in. I'm on track to get this, the target number I want to have. Typically, 7 figures is nice, whether it's $1 million, $2 million. The cost of living keeps going up. We want to keep up with inflation. But these are all projections that I can run on my system and share them with you, and we can tweak it as well, depending on your individual planning and needs. Okay, by talking to a financial professional, of course, again, you can determine the appropriate retirement savings goal, what you're going to need depending on your lifestyle, right? Do you want to be traveling more? You want to have a second home? You want to factor in inflation, future healthcare costs, right? Life expectancy. Also, maybe you want to help kids, right? Grandkids and such with education. You want to develop an investment strategy to help address long-term needs, of course. So again, discussing your planning and your current, investments with a professional would always be a good recommendation, whether it's me or somebody else. Definitely, these are free consultations that are offered, so that's something that you should really look into. You want to also help balance your retirement savings goals with other financial expenses you may have. Again, maybe you want to travel more, maybe a second home. And again, making sure that you're regularly tracking your investment portfolio to make sure you're on track to hit that target retirement bucket number, adjusting, for different, setbacks in the market. Of course, the market goes up and down quite a bit. This year, we had a little shaky start right in April. The market was actually down 10% at the beginning of April. Then the tariffs came out. We dropped another 10%. We were actually down 20% on April 8th. As of today, we're up about 30%, 10% for the year. So that means we bounced about 30% from the lows in April. But again, the market is up about 10 to 11% year to date. So the market here is very resilient, whether it's this year with the tariffs, COVID, 2008, the market seems to come back really, really quickly here. And typically when you're cost averaging and putting money in, right, every month, you're cost averaging, which is you're putting money in at lower levels or higher levels, and it compounds. And over time, again, the returns come through to the bottom line, and you have to just have a long, term horizon. And really, again, it all ties back to starting early as you can and putting as much as you can away into retirement. Okay, now here is another stat that typically we should save enough money to replace 75 to 80% of your pre-retirement income, okay? So we'll run the numbers. Everyone's making a different amount. We want to say, how much am I going to need? But typically as a benchmark, 75 to 80% of what you're making is your target that you want to, I'm going to build up this amount of money, whether it's $500,000, $1 million. And from that bucket, I'm going to take out 5, 6, 7%, right, per year divided by 12. So we can really fine tune the numbers and see how much you're going to be able to generate depending on how much you can save. And of course, we're going to assume you're going to pay federal tax. If you're still in California, you're going to pay state tax. A lot of members would move out of state, right? Whether it's Texas, Nevada, and pay maybe no or little state tax, right? Or possibly no state tax at all. And some have different needs. Some may need more than the 75 to 80%. Others may need less, depending on each member's and retiree's individual circumstance. But definitely, depending on your own situation, these are things we want to take a closer look at. Okay, in situations where you might need less income, right, than what you're making, maybe less than 75 to 80%, one, maybe your mortgage will be paid off, right? You're going to pay your mortgage off, so that'll be a big savings of what you're paying every month. Secondly, you might be downsizing to a smaller home, right? That would be another way you may not need as much income. Maybe, again, as I mentioned before, you want to relocate to a less expensive city or maybe out of state. Also, maybe you want to plan to work part-time into retirement. Maybe, for some of the time you retired, maybe it's some part-time work. Also, you might anticipate some other sources of income, ideally from your portfolio, right? Again, depending how much you have in your portfolio, if we can generate 5, 6, 7%, that's going to help offset, right, how much you're going to need. That's going to be a nice income stream to supplement your income. Also, Social Security, right? We typically don't plan too much on Social Security. These amounts aren't typically the biggest, but that will also help. We can also obviously get projections how much your Social Security is going to be. That'll be another source of income. And last but not least, maybe you no longer have to financially support children or grandkids. And there could be other factors as well. But these, again, are some of the main factors why you'd maybe need less as we go into retirement. Some of the situations where you might need more, maybe you're going to have a mortgage still into retirement. You're going to continue making payments on a mortgage or maybe a second home. Possibly you want to travel, right? Start traveling more extensively or purchase a second home. You might need higher healthcare costs, right? Higher healthcare needs or medication expenses. Possibly you anticipate needing long-term care. Long-term care, of course, is something to look at. We don't talk too much about long-term care, but sometimes we might need assistance at home, right? We might need someone to come in and help us as we get older. If we're married, right? We can help each other. But again, long-term care can wipe out a lot of fortune. Long-term care could be 3, 4, 5,000 a month sometimes. Whether it's at home assistance, maybe as we get older, we might have to go into an assisted living home. Again, these are sizable amounts into the thousands of dollars that you want to plan for. In this case, you definitely would probably need more. I've seen some couples that live in an assisted living home that pay 8, 9, 10,000 a month, right? For a couple of two, right? For a couple. So again, these are really pricey things to look at. There are plans, of course, insurance you can get for long-term care. Some investments have long-term care built in as well. So something to look at and say, hey, does my plan have or offer long-term care? Am I participating? So something to look at as well, depending on your family, how the family's done. Maybe you're going to need long-term care. That's something to look at. Also, if you plan on starting your own business, right? Some folks say, hey, I'm going to retire. I'm going to have my own side business. In that case, you might need some extra income. Also, if you need to maybe help children or other grandkids, right? Grandkids or family members that might need support. Or last but not least, if you believe Social Security benefits may not be enough to get you by, right? You're not going to have enough with just Social Security. Another situation where you might need more into retirement. Okay, in general, some of the savings benchmarks, if you're in your 20s, you want to try to save between 7 to 10% of your annual income, okay? Into your 30s, if you can target to save 10 to 15 is a nice number there. Into our 40s, you want to try to save between 15 to 20% of your annual income. And into our 50s and 60s, maybe we're catching up a bit. We want to try to save as much as 20% or more, if possible, again, into our 50s or 60s, so we can catch up and really put as much away as we can into the pre-retirement accounts. Okay, now we're going to go over DROP. Okay, the deferred rollover program. DROP, of course, is offered through the city here. It's basically your last 5 years when you go into before retirement, you have an option to pay your pension into a pre-tax account. This is typically a 5-year plan, and some folks say, should I go for the higher pension? Should I go 5 more years? Should I do 2 years, 3 years? Depending on, obviously some folks I've seen, hey, I'm done. I just want to retire. If it were me, I would always opt for doing the 5 years of DROP. I've seen an average balance coming out of DROP after 5 years be about $500,000. So I think, if you can write it out the last 5 years, I would definitely recommend going into DROP, staying the full 5 years. It's going to be another big bucket of money apart from your deferred comp. Okay, and you can take your deferred comp, you combine that with your DROP money, and then typically you would roll those over into an IRA. You take both accounts, they're both pre-tax, roll them over into an IRA, again, an individual retirement account. And then from there, you say, okay, I'm going to have a pension, or maybe I won't have a pension. I have this amount of money from the DROP and my deferred comp. How much should I distribute? I want to get an extra $2,000 a month of interest, right? Pre-tax. Or maybe I want 1,000 or 4,000 a month. So again, you take these buckets of money and we kind of plan, okay, how much supplemental income do you want per month? And for my members, what we typically do, we try to take money out monthly out of interest earned, not out of principal. We leave the principal earning. So when we focus on income, by the way, and distributions out of the retirement accounts, our first objective is income. Our secondary objective is still get growth. So what I do is we look at portfolios back tested. They're doing 11, 12% total return. So if you say, hey, this investment is doing 12% a year, if you're taking out 5 or 6%, the difference, your money is still growing, right? So when you're taking distributions and interest, you can of course take interest out of CDs and bonds. CDs and bonds are one way to go. You can get 6, 7% as well. And your money's going to be kind of going sideways for the most part, right? If you do a CD, the money comes due, you get the money back. However, CDs these days are paying about 4%. So the point here is really when you come to the planning age and you're taking distributions, ideally taking it out of your earnings, whether it's dividends and interest. is the first objective, and second objective is still getting some growth. Again, if you're doing a 12% total return investment, you take half of that out, 6%, your money's still going to grow typically by 5-6%. So you're still getting some growth. So that's how I do really my distribution in income portfolios. I would typically have a portfolio diversified of a variety of investments that are giving you the income and still getting some growth as well. So some basics here with drop. Again, we can also look at specific situations about drop. But again, if it were me, if you can hang in there 5 more years, it's going to be really, really a good payoff when you see the amount of money that you built up into the drop after the number of years. And of course, again, it's pre-tax. Okay, that brings us to the end of our presentation here, folks. On the screen is my contact information, my email, of course. Again, I'm at the Academy branch daily. I go to the other branches by appointment only. I also do Teams meetings and WebEx meetings, so I'm happy to do those. I do in-live presentations as well. I've done several at a variety of the departments. And okay, of course, with members that move out of state, we can do video meetings on the screen to help you visualize, and plan and look at the investments we're doing. We can also review what you're doing in your current accounts. If you are participating in Voya Deferred Comp, I can help you manage money while you're in Voya, while you're still working. I can manage the money through Voya. I can help you manage it through the Schwab Personal Choice Accounts, the Schwab PCRA, as it's called. Also, if you're over 59 and a half and you're still working, most employer plans allow you to do an in-service withdrawal. That means I'm still working, but I'm over 59 and a half. So you can do an in-service withdrawal and move money over to an IRA. Again, the main benefits of doing an IRA rollover, it opens up many more investments that do extremely well, and you get better performance. You have many more investment choices. And you can add protection, right? Hey, I'm in the market right now in my employer plan with no protection. I'm trying to grow it. In the IRA, you can have a 20% protection, 30% protection, even 100% protection, and still be in growth. And again, you can do CDs, bonds, and a variety of things that'll pay you 6, 7%, even 8%. So depending on preference, these are all portfolios that have a proven track record. And again, it's a variety of holdings, 5, 10 holdings or so that we build, we monitor, we review to make sure that we're on track. So no matter if you're in, again, pre-retirement, after retirement, also folks, outside the retirement accounts, if you have money sitting in a savings account, checking accounts, large balances, I do have things that pay you 4% that are fully liquid. So there's a variety of things you can do with non-retirement money. Obviously, also in the credit union, we have CDs. I have other tax-deferred investments you can do to lock in the rate for longer. That'll give you 4 or 5% with no tax till you start taking it out. So somewhat similar to the IRAs, tax-deferred growth and tax-deferred income with protection as well. So I'm going to stop there. I can go on, but again, if you have more questions, you want to learn more strategies, I've been doing this about 30 years. I've seen a lot. I only do investments day in and day out. I sit in the branch. Call me at your convenience. I typically work by appointments because I want to make sure I give any member at least an hour if possible to go over questions, but we do as many meetings and calls as you want. We appreciate your service out there. I know you do a lot, and I'm happy to give back with what I know and my knowledge, and I'm here for you anytime. Thank you all for your time, for your service, and please reach out with any questions, and we'll be opening it up here for questions and answers. Thank you all again.
Well, thank you, Pat. A lot of information, despite our rocky start. Okay, so we've got a few questions in the pipeline. So the first one comes from Melissa, and she's asking, can you work and still collect Social Security? And then when should you claim Social Security? Great question.
Yeah, you know what? Social Security, it's a tricky one because the longer you wait, of course, you're going to make more money, right? And the best is to call Social Security and get the projection. If I retire now, right, what's going to be my amount? If you can wait and put it off, the longer you can, it's going to be more money in your pocket. You can get Social Security and be working part-time as well. So you can definitely do that. But you want to call, the laws are always changing as well. If you have a CPA, you want to run that by your CPA, right? Taxes are a different arena. I'm not a tax advisor, but you also want to make sure that you're getting the best you can. So always check in with me and a CPA. Sometimes we work hand in hand, of course. We want to make sure there might be a new tax law. There might be another loophole that gives you another benefits. We want to make sure that we check with both resources, again, CPA, accountant, to make sure that we're getting the best possible return and the most income even while we're working.
Okay, awesome. So the next question is, when you roll over a drop and deferred comp into an IRA account, is there a minimum withdrawal age of 59? Is the minimum
Actually,
withdrawal age?
59 and a half is the age where you don't get a penalty. So if you want to wait till 59 and a half to not get a 10% penalty, unless it's a 457 plan, the 457 has no 10% penalty. So the age where you have to start taking money out, the required minimum distribution age is 73. So 73 and a half. So when you turn 73, 6 months later, you have to start taking money out every year, required, mandatory. If you don't, there'll be you get a penalty. But so basically you take out money at 73 and a half. You can take out money before then, but ideally you should wait till you're 59 and a half so you don't have a 10% penalty, with the exception of the 457 plans. And then you pay federal and state tax as you take it out.
All right, awesome. Next one, Pat, is she wanted to confirm if she heard right that a 4% average RMDs. So at $1 million, traditional IRA is RMD 40K.
That's right, about 4%. And that goes off the prior year's value. So let's say you turn 73 this year. They're going to take last year's value at the closing of the year, December 31st value of your retirement account. It's about 4%. We can calculate it as well. So there's a calculation, but it's typically about 4%. Absolutely. So again, and on that note, let's say if you have $1 million, they say, I'm retired now. We can generate 5% interest, right? Hey, I'm taking out 5%. You're going to meet your RMD. You're going to take out 4% or 5 or 6%. Your RMD required minimum has been met, but you're taking out money out of interest, not your principal, which is a big benefit. Right. You're taking out of interest earned, but it is about 4% and about 40,000 on $1 million. Absolutely.
Nice. We got some people calculating their interest. That's awesome. Okay, so next question is, can you roll over 401k from a previous employer into a 401k with the new employer?
Some employers will allow that. It's on a one-off basis. You have to check with the current employer. Generally, it's a 50-50. The majority may not, but if you don't, then you just go to an IRA. And actually going into an IRA is a much better benefit anyway, because you're going to have many more choices and to do better performance. A lot of times in the employer plans, they just say, hey, I'm in large cap growth. The large cap growth, like for Voya, it's just the S&P 500. But there are, the S&P 500 is a U.S. benchmark. It's a strong index, but there are a variety of institutional mutual funds that beat the market for year to date, 1 year, 3 year, 5 and 10 years of outperforming the market. So again, another benefit of rolling into an IRA versus trying to contribute to your current employer plan. But that would be, again, back to the current employer if they allow it or not.
Got it. Okay.
Yep.
The next one mentions, can you go over the catch-up age for contributions?
Yeah, the catch-up age, if you're over 50 years old, it's an extra 1,000. Okay, so the current contribution is 7,500 for IRAs. If you're over 50, and for the 401k employer plans, the contribution limit is 23,500. IRAs is 7,500. If you're over 50, it's an extra 1,000. Okay, if you're between 60 to 63 years old, it's 11,250. But again, but over 50 is pretty common, an extra 1,000 per year.
Okay. All right. Next question is, while earning a pension, can a retired employee pay into a Roth IRA with the pension as their earned income?
Through your pension. That's a good one. So if you're asking if you can do the Roth IRA as earned income from your pension, right?
Mm-hmm.
I don't believe that's an option, but I have to check it. Mark that, right, and I can get back to that member. I have to check with my retirement planning strategist team, because there might be a loophole as well. Typically, to contribute to an IRA, you have to have earned income. Earned income is really the key word. Pension may not qualify. I'm going to lean towards a no, but I'll double check and I can follow up with that member. But typically, it's going to be earned income that you're earning maybe through an employer, right? Employment. But I'll double check and confirm that with that member. If they can send us the information, we can follow up. Yep, absolutely.
We'll get back to you guys.
Yep.
Flagged it so after the webinar.
Yeah.
Okay, so the next question is, can I roll over an external Roth IRA into a Roth IRA into a Roth account with Voya? So can I roll over
Uh,
an external Roth IRA
Again,
into?
typically it goes the other way. That would be on the Voya. So you would have to call Voya and ask them because there's limits, right? There's limits, but depending on the employer, it'd be up to the employer. In this case, Voya, if they allow it or not. Because typically the rollover goes the other way. So that'd be on each employer would have different guidelines, whether it's Voya, T. Rowe Price, et cetera. We'd have to check with them. And I can help do that call with the members. We can call together and we can find out. But every employer plan is going to be different.
Okay, great. Next question is, can I roll over a regular IRA into a Roth, and is there any tax advantages?
Yeah, that's a good one. There were back in the day there was a big IRA rollover. That is a yes. You can definitely roll an IRA over to a Roth. There was a big IRA Roth conversion that happened about 10 years ago. So that's allowed. The thought there is, hey, I'd rather do my rollover now and convert it to a Roth and pay my taxes now because I believe taxes are going to be going up. I'm going to pay more taxes later. So that definitely is a yes. You can definitely do a conversion. It's going to be a big tax amount, right? A big tax amount. So the more you have in your pre-tax, it's going to be a big tax. So if you have a 6-figure retirement IRA pre-tax, you do a Roth conversion, you're going to have a big tax bill that year. And it's going to be due. And so the more you have, apart from your income, that conversion balance is to be additional income for that year. So you might go from 22% federal to 34 or 35% federal, maybe 40%. So you're going to have a big tax bucket. But again, you can do that. The idea there is if you think taxes are going to be higher, you might want to bite the bullet now and pay the taxes, but we'd run the numbers to see if it's going to be beneficial or not. But yeah, that's a yes.
Okay, great. This one, next question is maybe a little bit more on the personal side, but the question is, I'm currently funding my 20-year-old daughter's college expenses. I have been retired for 20 plus years and my savings account is my funding source. I see my savings going down very fast and this year is her junior year. I'm in trouble. It says I'm in trouble. So far, no scholarships or grants thus far.
Okay, run the initial part again by me. She's contributed to her daughter's savings college account.
Yeah, so the member is currently funding the 20-year-old's college expenses, and they've been retired for over 20 years, and that they see that their savings accounts is depleting. We may need to get back to you with that one specifically.
Yeah, on that one, as in a nutshell, typically in that case, I'd say how much you have available. Instead of taking it out of your principal, if you have enough to just get interest, right, and take the interest out, that'd be the ideal situation. Hey, I'm going to take my retirement money, whatever I have available, checking savings, retirement buckets, and let's get 6, 7, 8% interest and take that interest. And that'll pay forever, right? That'll keep paying you. That's typically, but we can look at that specifically and run the numbers if you have enough resources to generate enough income. But that's going to be a tricky one because if you're taking out a principal, it's going to last a certain period of time, right? That's going to be it. That's why, again, we want to save and have as much as we can. And again, if you have $1 million or even $500,000 or 250, you can get a good amount of income per month off the interest. But we can look at that specifically, depending with that member, she can reach out to me or they can reach out to me at their convenience.
Okay, great. Got a couple of more questions. So the next one is, am I able to roll over, drop money into a deferred comp account and leave it there after I've separated from the department?
Deferred comp. Yeah. Actually, deferred comp, you can roll, deferred comp. They're all pre-tax, so you can leave the money there, even into retirement. Some folks will do that. Some folks say, hey, I have another IRA of a 401k from my previous employer. So you can definitely do that. After you retire, you can leave it there within Voya or the Schwab PCRA. But again, there's a lot of benefits to roll into an IRA, but you can definitely do that. Yeah.
Okay. Awesome. So the next question, we've got two more. Next one is there any way to avoid tax on withdrawals?
Yeah, that's a tricky. Really, I don't believe there is. Again, that's more of a CPA question, but you know what? No, there's really on withdrawals. Unless it's your first time home purchase, right? There are situations again where, God forbid, disability, right? You're disabled or something like that. There are some provisions, again, more of a tax laws that are out there, some benefits, but in general, no, you got to pay tax. And that's why we're forced to take our RMDs out at a certain age. There's no way. I mean, you can roll it in to something that's going to defer it for a while. You can defer it and kick that tax bucket down the road. But at one point, you're going to have the RMD, required minimum distributions, where you got to pay that tax and pay Uncle Sam his tax, right? Federal and state taxes at one point. But again, CPAs would know, hey, there's a loophole here. If you contribute to a charity, right? I've had one member do that years ago. I'm putting into a charity. You can avoid some taxes that way, but you have to give your money up to a charity. So there are a couple ways, but typically a charity might be one. That's one for sure. Yeah, not if
All
you're
right.
paying yourself though.
Got it. Okay.
Yep.
Next question is, if I want to start withdrawing at 55, I should not roll over my 457 deferred comp account to IRA, correct?
Yeah, you're 55.
If they want to start withdrawing at 55.
Yeah, unless you're retired, right? And for you, you're talking about employer plan to an IRA, right?
It says here, I should not roll over my 455 deferred comp account into an IRA, correct?
Yeah, unless you're retired. If you're separated from your employer, then you can, of course, right? Then you can. But if you're still working, you're 55, no. And in that case, if you want help, we can still help you within Voya or within the Schwab account. But yeah, if you're still working, only if you're separated, then you can roll it over from a prior employer. Yep.
All right, we've got one last question, and then what I would encourage everyone to do is take a photo of Patrick's contact information if you want to reach out to him directly. Furthermore, after this session, for any like personalized information that you need clarity on, that would be the best way to go about it. But the last question is, isn't there a limit on how much you can be rolled into DC each calendar year?
Yeah, the limit, the deferred comp is that's at 23.5 every year, 23,500. That's that amount. That's the current amount. If you're over 50, it's an extra 7,000, I believe it was on that cheat sheet there. I had 7,000. So 23.5 is the standard amount unless you're over 50. Then there's a catch-up provision. That's the max. So if you're maxing that out, then other than that, you can put money in other locations, outside of DC plan. And there are other accounts outside of the deferred comp that you can put money away tax deferred. Even money in your savings accounts. Hey, I'm maxing out my deferred comp. Where else can I put money to make it work so I'm not paying taxes? Then we look at other strategies that we can put money away for a fixed rate or in growth and defer the taxes until you start taking it out of those plans. Right? That's the idea. So there are some strategies out there, absolutely. By the way, if anyone's selling homes, there are strategies that you can use to not pay taxes on capital gains on home sales. These are exchange accounts that offer you, hey, I've been a landlord for many years. I had tenants. I'm tired of being a landlord. I don't want the tenants. I like the income. I'm going to sell my property or your personal residence. You don't want to pay taxes. There are some programs we can use to roll those proceeds into something else, more like a REIT, a diversified real estate investment, that'll still give you an income stream of about 6% or so without the headaches of tenants. So that's another basic out there. Any more questions at the end before I do a couple more housekeeping, Natalie?
That's it for in the chat box in the
Yeah,
Q&A panel.
As Natalie mentioned, I'm bilingual in Spanish, of course. I'm fluent in Spanish. If you do happen to call me, I'm typically on the phone almost nonstop, really, from the way into work. So if you happen to get my voicemail, I typically try to call you back the same day. Worst case, within 24 hours, but I try to make it a point to reach back out. Again, my number's there. The top number goes right to me. My mobile, of course, as well, because I travel remotely between branches. And also in our department, I'm open for any questions. There's no charge for me to help you consulting, etc. We have different platforms. I have many members that have investment accounts out there with 911 Finance, with JP Morgan, Merrill Lynch. I have friends and colleagues at all these other investment firms. I know exactly what everyone's doing. So really, I'm happy to share with you, help you learn as much as you want, answer questions. I'm also life insurance licensed. So somebody says, hey, I need life insurance. I need to protect my money, etc. There's a lot out there in the financial world, and we're here to help regardless of what your needs might be.
All right, very true. One-stop resource. So feel free to reach out to Pat, and if you want a recording of tonight's webinar, we can email it to you or just be on the lookout as it will be available tomorrow. Again, as we draw close to 7 p.m. tonight, I want to thank everyone for joining us this evening. There was a lot of great questions, a lot of great content, and we ask you guys to look out for future webinars and topics that we have slated in the future. Thank you. Have a safe evening and good night.
Thank you all. Good night.